After 16 years of compulsory super, you'd think we would have a handle on what it's all about. Fat chance. It's moving just far too fast for that. Before we get the benefit of Gary's vision for the future, here's what a few of your contemporaries had to say.
I think we're going to see continued consolidation in the industry.
I think we'll end up with 1 or 200 funds.
I'd like to see the contributions tax abolished.
Please welcome Gary Weaven, the Chair of Industry Funds Management and the spokesperson for the Industry Super Network.
Thank you, Fiona. Because this is a look back, look forward type approach, I've got to cover a fair bit of terrain here, so I hope that if I can briefly canvass the past and the present, then we can create some sort of a perspective from which we can begin to paint a big picture for the future. All history, of course, is highly subjective, and I've got a tabulated history which is at least explicitly highly subjective and therefore over-representative, of course, of my bias towards industry fund-related milestones. In the early 80s, somewhere well less than 15% of the workforce actually got any benefit out of superannuation. By 1990, nevertheless, something like 80% of the workforce actually had access to superannuation, and mainly fully vested superannuation. That, of course, was also the year in which CMSF itself was formed and had its first conference. In 1991, really the most important thing the government did, of course, was not so much the introduction of universality, because there was a large section already covered, but a decision to phase the contribution level from 3% up to 9% over the following 10 years. And by 2001, the industry funds had grown to something like 50 billion in terms of assets under management. ACSI was also formed that year, reflecting a milestone in terms of a dawning awareness of corporate governance as an emerging issue. And by 2004, 600 billion. And now we come this year to the total superannuation assets having reached that magical $1 trillion mark. As I said, a couple of years early on most estimates. Now, I just want to spend a little time on those aggregates and the significance of them. The first thing is the Australian economy, in terms of output, as measured by GDP, currently ranked number 17 in the world. The ASX is the world's 8th largest stock market by market cap, but the Australian managed funds industry is usually ranked 4 or 5. And that relative overachievement is entirely due, of course, to Australia's superannuation system. At around $1 trillion, the total assets of Australia's super funds are about to pass the market capitalised value of all the companies listed on the Australian Stock Exchange. The purpose, obviously, of all this is to demonstrate just how significant super has become, but more importantly, how important it will become to the nation's wealth and development. For example, a shift in asset allocation from an average, say, 45% exposure to the ASX to 20%, perhaps as a result of a shift to private equity or to global shares, would take 250 billion out of the market. On the other hand, maintenance of current allocations would result in 1.8 trillion invested in the ASX by super funds come to 2020. If we could get, say, an extra 0.5% of annual investment performance, and a further 0.5% reduction in costs, that would be similar in overall economic welfare terms to increasing nominal GDP by 1% per annum. Let me just contextualise that a bit further by reference to the cost of addressing global warming. When the Business Roundtable on Climate Change briefed the Allen Consulting Group to estimate the economic cost of achieving a 60% reduction on year 2000 emissions by 2050, that analysis showed, first, that the cost of taking early action would be approximately 0.1% per annum of GDP. Secondly, the cost of taking delayed action would be approximately 0.3% per annum of GDP. That would be more costly. Now, admittedly, they're referring to growth in real GDP, not nominal, but it's clear that the cost to economic welfare of taking strong action is well within the scope of what could be offset by our industry marginally lifting its game. This table sets out the most recently published APRA data. The basic picture is clear enough. Industry funds and retail funds are continuing to increase their market shares, while public sector and now DIY funds have flattened out and corporates continue their anticipated decline. Industry funds have again achieved the fastest growth rate, but that is somewhat misleading because of the relatively low base compared to retail and DIY. Excluding the DIY sector, the fall in the number of funds has been dramatic, as shown by that table. So licensing and competitive pressures together are having a significant impact on average expense ratios across the system, as the worst performed and higher cost funds lose market share or are closed down. The superannuation industry is characterised by lack of clarity as to costs, lack of standardised performance assessment, and therefore competition based on salesmanship, marketing strategies, and often misinformation, heightened by the pervasiveness of commission-based selling, often projected as independent advice. For that reason, the APRA licensing program and the inherent benefits of large economies of scale are far more effective in promoting efficiency and cost containment than the so-called choice of fund legislation. Indeed, examination of that legislation leads one to conclude that it's less about the right to choose than the right to sell. We know now from our net benefit research, and this is unattributed I think, but it's a super ratings chart, we know from that research that there's a massive gap between even an average industry fund and the average retail fund. That means that the contest for market share is of far more than academic interest. Its outcome will actually profoundly affect future levels of national savings. Another significant observation that can be made from the APRA report is that the main reason why retail funds have not clearly outgrown all other sectors is that they have much higher levels of benefit payments. Presumably they have an older membership profile, and certainly they have a larger share of the pensions market, where industry funds have a very low share of that market. So once you look past the distortion in market shares caused by benefit payments, what you actually find is a gradual increase in the retailisation of the superannuation market. For industry funds, that means there is an absolute imperative of further strengthening their wholesale workplace distribution strategies, while continuing to build public brand awareness, both individual brands and generic industry fund brand. And as I've said, that battle between wholesale and retail delivery is not of purely academic interest. It has a profound impact on long-term wealth creation. Let me turn now to investment performance. The Super Ratings survey of major balanced super funds, that's the funds for which they've got 5-year data, shows that the top 10 in terms of 5-year investment performance were all industry funds. The 1-year data, it's true, is less stark, but it's still weighted strongly towards industry fund performance. The underlying markets and assets to choose from, of course, display much more significant diversification of performance. This table provided by Frontier shows the huge differences over 1 or 5 years between performance of major asset classes. Let me now turn to the looking more forward part of what I want to say. First of all, overseas funds managers will continue to seek to penetrate the Australian market, offering scale, familiarisation with offshore markets, and or innovation or pseudo-innovation on some occasions. Innovative Australian managers will see opportunities offshore, and super funds will run up against capacity constraints in Australia. All of that will inevitably result in a fairly dramatic shift in asset allocation towards offshore assets. Currently, Australian super funds tend to hold between 50 to 80% of their portfolio in domestic assets of one sort and another. In the medium to longer term, I expect that number is going to fall very significantly. Secondly, unlisted investments are almost certain to become a much larger proportion of portfolios in the future. The ability to add value in less research markets and the ability to get a premium by foregoing unnecessary liquidity are the flip side arguments of the problem of lack of capacity of active fund managers to add value in the Australian listed equity market. At a more fundamental level, though, the very foundations upon which a large and growing stock market are based have come under real pressure, and we've seen some of that in the press. The stock market has been not only traditionally a means of providing investors with liquidity at a price, but it's been a remarkable engine for the aggregation of small investments into serviceable chunks of capital for the use of enterprises, both small and large. Notwithstanding the amount of regulatory and promotional servicing required, the share market has been considered a relatively efficient means of raising capital. The advent of the Australian system of compulsory superannuation, however, is beginning to challenge those presumptions of efficiency. Because whatever else may be said about super, it is clearly an awesomely effective means of agglomerating investment capital. And funds such as the large industry funds are growing in a manner, as I said, which makes short to medium term liquidity irrelevant. So it would not be at all surprising if the ASX came under severe pressure in respect to its relative future importance. First of all, a lack of political leadership in this country has meant that we've not spent anywhere near enough on economic, environmental and social infrastructure. With more foresight and leadership, a very large additional chunk of super would now be invested in renewable energy, water management, water recycling, waste management, public transport, rail freight, roads, education, health and aged care. And none of that would require stock market intermediation. Secondly, the level of the market itself is arguably a protection against privatisation. It may not be over expensive, but it is not over cheap. Certainly I think that at least some of the current rush of interest by merchant banks and private equity buyout funds is driven more by financial engineering opportunities and the consequent incentive of bloated transaction fees than by other more sustainable factors. So in an environment where absolute interest rates are low relative to anticipated returns, there will be a tendency, indeed a virtual compulsion, for gearing to increase. Of course, this cycle will end, perhaps in tears, when the economic environment changes to reflect either higher interest rates or lower anticipated returns, or both. At this point, huge buying opportunities may appear for that part of the super industry which is growing rapidly and can take a longer-term view. But there may also be the possibility of a more sustained secular trend towards privatisation based on the ability of private equity managers to add value, not through financial restructuring, but through management strategy and freedom from the short-term distractions of an often irrational listed market. Now, if that were combined with efficient wholesale capital raising from super funds and a radical fall in transaction costs as additional players step up to the mark, as starting to happen, of course, particularly in infrastructure investments, then a fundamental change in the central role played by the stock market could well get underway, whereby it's diminished essentially to a liquidity market for retail investors, mum and dad investors. Diminution of relative importance, of course, doesn't mean shrinkage in absolute terms. The third thing I wanted to say about long-term investment issues is that on the issue of concentrated capital. The relative scale of super compared to the ASX and the Australian economy also means that if super funds don't radically reduce their percentage allocation to Australian assets, then they'll have to accept a much greater degree of responsibility for management of those assets. If you look out to 2020, it will most likely be essential for fund managers and or funds to develop increasingly sophisticated arrangements for their interaction with company boards and minority shareholders. It also means that from a professional funds management point of view, the distinction between private equity and active management of listed assets will become blurred. This doesn't necessarily mean directly intervening in management, but it will, as a minimum, mean taking responsibility for the appointment of directors focused on achieving the investors' goals. Fourth thing is that formalisation and consolidation of more and more asset groups and business sectors into major enterprises and asset classes is also likely to be an ongoing consequence of the massive rise in super dollars. One consequence of that will be the deconstruction of asset classes and the need for sophisticated trustees and their advisors to better analyse and understand the risk-reward characteristics of more specialised asset classes or subclasses. The next thing I want to talk about is climate change. I simply want to repeat what I put on the record a couple of years ago. The likelihood of a panic reaction is at least as strong as the likelihood of inaction. So we better quickly develop our thinking and strategies for dealing with this issue. As a minimum, it seems to me highly probable that there will develop a bubble in the newly emerging green tech sector and that carbon credits will become a significant major commodity. That should strongly favour companies that can create those credits but it does not mean that the green tech sector will necessarily be a good place to be overweight. After all, most of the fortunes made from the gold rushes didn't accrue to the diggers. In Australia, the impact of climate change should logically fall most heavily on energy generation, where we need to shift the mix radically in favour of renewables and away from coal, and on water, where the glaring need in southern Australia is modernised irrigation infrastructure, and where, of course, northern Australia is very likely to get wetter. Recent years have seen an upsurge of interest in corporate governance, sparked largely by the extremism of corporate greed now prevalent amongst senior executives and their directorial clubs. This is a very difficult issue to confront on a company-by-company basis, or even on a national basis. It's essentially an international disease. But what it has done is united trustees from very, very different backgrounds around a realisation that without shareholder activism, a global erosion of rights and dilution of shareholder interests can rapidly set in. Corporate behaviour has an increasing influence over our lives and our futures, and it's a matter of simple social responsibility that those who represent the beneficial ownership of companies should express a clear voice on major issues of governance. As we've seen, the growth of super assets is likely to produce a very large degree of economic interest in Australian companies, both listed and unlisted in the future. There's absolutely no doubt that will produce a strong degree of reaction in certain circles, and that reaction will of course focus on the governance of super funds themselves. Once that's accepted, it's clear that if we believe in a particular model, we will need to vigorously defend and promote that model. And the best defence is success. We will need to manifestly succeed in our primary task of economic outperformance on behalf of the people we represent. Ideally, we also need to demonstrate leadership in terms of social responsibility, so that the challenge for those who will oppose our growing influence will be to demonstrate they can implement a better model. We work in a very special industry. What's most special about super is that it has the capacity to moderate the extreme inequalities of wealth that are otherwise the natural tendency of the extreme inequalities in ownership that are produced by free market capitalism. Super is super because it involves long-term savings of those who would otherwise not save. In this way, economic returns are compounded over long periods in the name of each individual. No amount of tax incentives or handouts is capable on its own of achieving that outcome. I fervently hope that at least a large section of the super industry remains committed to the collective vision that so many of us have advocated for more than 20 years. Thanks for listening to me.